So welcome back to the channel, guys. So today we're breaking down that age-old debate about stock market versus real estate and which investment strategy is better, man. So let's break it down. So at the moment, there's been some pretty bold predictions about where the market will end up when it comes to the S&P 500, okay? So the S&P 500 is simply the stock market's benchmark, okay? So it's got the biggest and the best 500 companies. So Wall Street investors like myself and other ones out there will use the S&P 500 as the benchmark. So we measure everything in the stock market against that, okay, to gauge where things are. And there's been some hefty predictions right now, okay? So there's a report that come out from BMO Capital Markets that are saying that they think the S&P 500 could see ended the year at 6,100 points. Now, for context, right now the S&P is around about 5750. Okay, so they think that the S&P is going to produce another 5 to 6% in gains. All right, and that's a hefty prediction because already this year the S&P 500 is up a whopping 20% from January until now, okay, which is a crazy return, and not many asset classes out there will produce that kind of return for you. All right, now for myself personally, I think we'll squeeze another 3 to 4% out. I think conservatively, I think the market's had an amazing run, especially when it comes to the real estate market, which hasn't been that optimistic generally. This year it's had its blips, but for the most part the sentiment hasn't been great with real estate. Okay, so that's quite interesting. Now obviously big money, we're seeing hedge funds, we're seeing Wall Street investors are really focusing on the stock market, so it seems. So look, let's jump into the comparables of the investment strategies, okay? So let's just take easy numbers. Let's take 100,000, all right? So obviously you don't have to start with 100,000, but for the use of this example, we're gonna use simple numbers. So if you invested that 100,000 into the stock market and it grows by, let's say 10%, okay, which is the market average, you make that 10 grand, okay? Those are easy numbers, all right? 100,000, 10% return, 10K, all right? But let's take that same 100,000, all right, as we did, and we use it as a down payment onto a property. Let's say the property is 500,000, okay? The dynamics of that investment then massively changes, all right? So what happens obviously when you're getting a mortgage, when you're buying a property, what you're using is something called leverage debt. So if that property increases in value, okay, let's just take that £500,000 house goes up to £550,000, all right, over let's say 2-year period, you've now gained a £50,000 equity in that house. So on your initial £100,000 investment, that turns out to be a 50% return, okay? Now that 50% return sounds a lot better than that 10% return that we'll get in with that same 100,000 in the stock market, right? But not all is smooth sailing, because obviously when we go to buy a property, there's commissions, there's fees, there's taxes involved, okay? And what happens then, your net gain, your gain that you get to keep, that is, might be considerably lower than that of the stock market, okay? So that's a crucial point that we need to understand, because real estate involves those additional costs, all right? And a lot of people talk about the additional costs on there. Now, of course, with stocks, you're going to pay taxes, but it's called capital gain tax, and those are capped at particular percentages. There's no extra fees, there's no hidden costs, no middleman fee when you're playing with stocks, all right? It's simply buying and selling, and you pay a tax for doing so, all right? And if you want to avoid that tax, you just simply wrap your stocks inside of something called an ISA, okay, which is an individual savings account, and it protects those assets from being taxed, all right, no matter what they go to in gains. But when it comes to real estate, like I said, those additional fees, those taxes can massively eat into those profits, man. And people don't often talk about that. You see a lot of people online talking about real estate. They talk about the flips they made, but they don't really go into the net margin. They don't go into the net gain that they make. They don't talk about the commission fees. They don't talk about the taxes. They don't talk about all those middleman fees. They just show you the end result, and more so, it's called the gross. They tend to show you the gross, which is the overall revenue, or let's say the gain that it makes. But then, like we said before, those taxes, those fees, those commissions, cut it down, and that gives you your net number, okay? So that's the number we need to be looking at. And relatively, over time, stock market gains, when it comes to that net amount of gain, usually outperforms the real estate market, okay? And the thing is, why this is important to talk about is because a lot of people who are solely in the real estate game, they tend to miss out on big opportunities in the stock market just simply because they demonize an asset class, or they feel they don't understand that asset class. And it's a misconception, and it's a silly thing to do, to demonize any asset class, all right? So opportunities like the tech boom we've had this year, last year, and 2021, where the market was absolutely killing it, right? You know, we're seeing, you know, the big companies, your Apples, your Nvidias, your Amazons, you know, killing it. We're seeing Nvidia do 2 years back to back at 200% plus gain. You are never going to get those kind of returns in the real estate market, okay? And yes, those are phenomenons. Those are not typical returns, but not looking at these asset classes like stocks, and you're solely focusing and you pigeonhole yourself looking at particular asset classes, just like real estate, or if you're into different asset classes, you're missing out on money. You're leaving money on the table, man, which is just a silly thing to do. And it can end up in huge losses, man. So the main thing is, like I said, you've always heard about diversification before. It's so important to have exposure to different asset classes and not pigeonhole yourself and just focus on what you think is the best thing, because usually you'll miss out. So, you know, it's important to have your crypto, it's important to have your gold, it's important to have stocks, it's important to have real estate, of course. You know what I'm saying? Don't put all your eggs in that one basket, man. Spread those eggs around a little bit. I can empathize as well why people gravitate towards the real estate market, and it's because of the tangible benefits, all right? It's very easy to understand that, because again, real estate is physical, it's tangible. You can go touch your real estate, you can go, you know, you can go visit these properties, all right? And people feel like it's easy to understand. It's more simple. It's not over their heads. They can literally get money, put a deposit down. They've got something physical they can actually touch and feel, and I can understand that, and I can empathize with people on that side of things. And it feels like a sense of security and stability in a way, because it's understandable. Because myself, I'm in real estate myself. Like I said, I don't demonize any asset classes, so I can get it from other people's point of view as to why they may not gravitate to things like crypto and stocks and things, because you can't physically touch your stocks, all right? So there's that tangibility aspect. And also there's lifestyle benefits when you think about it. When you know, with real estate, you know, there's location, you know, if you've got kids, there's school district, you know, it's all those things as well, which is understandable. And like I said, I can empathize with people why they gravitate towards it, but it's just, you need to kind of get past those barriers, those tangibilities, and start investing in intangibilities as well, because those are also money makers, all right? But when it comes down to it, man, no matter however you want to slice the cake or however you want to cut the cake, when it comes down to pure returns, like we said, that net pure return, stock market has historically outperformed the real estate market, man. It's just the way it's been. I don't make the rules, it's just what history shows me. So look, practically what should you do, okay? So you need to obviously consider your income and consider your expenses, what's going out the door, what's coming in the door, whether renting or buying's better for you. That's a huge decision, and that's depending on your situation. It's circumstantial. It was for myself when I come to buy a property. But also you need to understand and calculate going into that decision of buying or renting a home, what those, you know, those taxes are, those property taxes in the UK, those council tax fees, you know, the interest rate you're going to be paying on that mortgage, and also look at those potential returns, those equity gains in that property, all right? So the way you can conceptualize it and think about it is, think of those taxes when you're buying a property as essentially rent you're paying to your district, all right? Your region, your city, whatever it is. And the interest you pay on that mortgage, that loan, is the rent you're paying on the money that you're getting, all right? So it's very important that, especially in times we're in right now, you know, cost of living crisis, you know, everything's high, inflation's still crazy. It's important that we live conservative, all right? It's very important that we live, you know, I know it's easy to say live below your means, but also it's important to make smart investments. Don't over leverage, don't spend too much on things that aren't bringing income producing assets into the household. That's crucial. So we need to understand that. That's very, very important. But for those who, you know, potentially prefer stocks like myself, I'm definitely a stock market man. I think the best place to start for you, and the way I started, is cost averaging. Just simply buying the market. Like we said at the start, the S&P 500 is a great place to start. You're getting exposure to 500 of the best businesses, and you're putting money into those. You can set that budget. You can either do it weekly, you can do it monthly, however you see fit. You're just putting money in there, letting it do the hard work and the heavy lifting for you, and you're going to average it anywhere between that 8 to 10% annually on your money, which is an amazing return. You're not going to get that sitting in a bank account. So that's a great place to start for people who are potentially leaning more towards the stock market, okay? And often the yields are going to be better than putting that into a real estate property. So look, recently, man, the stock market's been an amazing wealth building tool for many people like myself, for many 9-to-5 workers. It isn't just for the ultra rich. It's definitely helping people get their freedom goal a lot quicker. You know, the companies like Apple, your Microsoft, your Amazons, your Nvidias, at corporate level, they all offer things like stock options. So you can either have increasing pay, whether you're coming around to a promotion or a raise. You can choose to either have it in cash, or usually they will kind of push you towards a stock option route, really. So you're having equity in the business, so when that stock grows, your net worth grows as well. And we've been seeing recently this year that Nvidia employees have now become millionaires, which is just crazy, man. And it's amazing that the stock market can provide that. And I think that's why it's always what I will push forward, because it's what's helped me move my trajectory financially with a few small tweaks, and I know it can help yours. I don't have to have ultra money to make ultra money in the stock market. Yes, of course, starting with more, you're going to yield more a lot quicker. But I started very, very small, believe me. And in a few short years, my trajectory has been astronomical, and it's forever growing, man. And of course, now my kids are invested, and by the time they're my age, they're going to surpass me, man. So that's what the stock market can really do for you, man. It can really bring that freedom goal closer to your current realities. And when investing in capitalism and innovation, it often will pay off. All right. In conclusion, man, the stock market versus the real estate market, at the end of the day, they both have their pros and cons. Like any investment, man, just make sure that you diversify that risk, like we said before. Make smart investment choices, because at the end of the day, it's your hard-earned money. And no one cares more about your hard-earned money than you. So it's down to you to take a little bit more of that time to really understand what you're putting your money into, okay? Because you've gone out to work, you've used that time, you can't get that time back. You've utilized that time, and it's resulted in some money. Now that money needs to be invested into smart places. So you owe it to yourself just to take a little bit of that time out. Start really understanding where you want to place that money, and what suits you is down to you. Just balance those risks, balance those rewards, and make the decision for yourself, man. Thanks for watching. If you found this video helpful, hit the like button, share your thoughts in the comments, and don't forget to subscribe for more financial insights, man. I'll see you guys in that next video.